Hey, it's Cliff, and today I'm going to talk about the number one stock that I plan to invest in for the year 2022. So, it's not actually a stock what I'm going to be investing in, it's actually an index fund. And if you don't know what an index fund is, an index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market. And this is according to Investopedia. So basically all this is saying is a index fund is one ticker symbol that you can purchase that has a group of stocks in it that you can buy. So you're well diversified in this. And the stock that I plan to buy is the Vanguard Total Stock Market Index Fund, which is known as VTSAX. Now you can see the reason why someone would purchase something like this is because when you're purchasing an individual stock, let's say you purchase Tesla goes out of business. At that point, when Tesla goes out of business, you're done. Like you lost all your money. If you have a index fund and Tesla's in that index fund goes out of business, you're still good to go. So there is a diverse portfolio here for VTSAX. You can see they invest in basic materials, consumer discretion, consumer staples. They got the energy sector, the financial sector, healthcare, industrials, real estate, technology, telecommunications, utilities. Pretty much everything that you're going to want to invest in is right here. So the fees for purchasing something like this, you can see, is 0.04% annually. And that's comparative to similar funds would be 0.82%. And to kind of get a feel of what you'd be paying if you invested $10,000 over 10 years, you'd be paying about $95 compared to similar funds you'd be paying around almost $1,900. Now, obviously these numbers are very low and it's only for a 10-year span. If we're talking about the lifespan of retirement, it's going to be probably 30 to 50 years and you're not going to just invest $10,000. So it's going to be many multiples of that $95. These small fees actually do add up really quickly, even though you might look at that and think 0.04%, that's nothing, I don't even care. But just know that these definitely compound and you pay quite a bit over the lifetime of owning something like an index fund. So what kind of stocks are in this? Well, they got Apple, you got your Microsoft, you got your Amazon, your Tesla, your Alphabet Inc., your Nvidia, pretty much everything that you want to invest in, everything that's doing well in the US economy is going to be in this. You have Facebook, you got Visa, PepsiCo. And one thing that I often hear is that this is a American fund, which is true. And some might think that maybe you should invest a little bit in international funds. But the way I like to look at this is that these American companies are also overseas. When you think of a company like Pepsi, they're drinking Pepsi over in Asia. So you're already pretty well diversified by purchasing an index fund like this. Now, also in this, you'll have bonds, and they also keep a short-term reserve, which is just a liquidity fund. It's just cash. So when they want to purchase more shares of, different stocks, they have it on hand. But let's get to the important thing that people probably care about, returns. So last year, this fund did almost 26%. And you can see as well that there was a yield of 1.25. That just means there's a dividend on this. So quarterly, I received cash just for owning these, which you could take and spend if you really wanted to. Personally, what I do is I just reinvest it back in and hope over time that it compounds and we start making some really good money from that. But even, we had a really good market this year, and some might say, well, how is it performing the year before? 2020, we're looking at almost 21%. 2019, it was almost 31%. Had a decline in 2018, negative 5%, but when you average the money that you've already made, you're still way into gain territory. So it's doing pretty well. One thing that I've heard probably since 2017 is that we're due for a market crash, which could be true. And I think for the most of us who are watching a video like this, that's okay because we're still investing. So let's say if the market crashes this year and we're putting a lot of money into this fund, we're just going to be better off next year. That's almost something that we would hope for. So, anywho, moving on from that. So there's a pretty well-known guy in the FIRE community, which is Financial Independence, Retire Early, if you don't know. And he is J.L. Collins, and he wrote a book called The Simple Path to Wealth, which is a really good book. I've read it. It's short and sweet, but it's a very strong proponent for the VTSAX fund. And even people like Warren Buffett, there's a quote in here, I do believe, from him. Yeah, even someone like Warren Buffett states that 90% of your holdings should be in an index fund. Now, he stated the S&P 500, which is included in VTSAX. So, but back to J.L. Collins, one of the things that he's known for mentioning is that this particular index fund is self-cleansing. And so basically what he's saying is the S&P 500 index, which tracks the largest 500 domestic companies, and the Russell 3000 index, which is tracking the largest 3,000 domestic companies, represent 98% of the stock market. Okay, fair. Well, 320 companies held in the S&P 500 index suffered substantial declines in their market cap and were removed from the S&P 500 index. So, for the Russell 3000 index, 40% of stocks in the Russell 3000 index suffered a catastrophic loss or more that was permanent. The individual stocks never recovered, though the index increased. So what's going on here is basically as companies decline in the stock market, they are cycled out of these index funds, and we bring in companies who are performing better. It works almost similar to a mutual fund, but mutual funds are different because they are actively managed by a human person, and the fees are way, way higher. Also, when you think of a mutual fund being managed by a human, it brings on maybe psychological losses that could happen. Let's say if there was a big crash, they might want to immediately adjust your portfolio, and that typically is not the best thing to do when a crash happens. The best thing usually to do is just invest more. So the index fund will have lower fees, and it's almost like using an algorithm, kind of like YouTube. So I'm all for it. Definitely something that you guys should look into because of its self-cleansing method. Now, you're probably thinking, well, Cliff, I don't have Vanguard. I use Charles Schwab. Well, there's going to be a total index fund pretty much for any company. So if you have Schwab, for instance, you're going to be using SWTSX. If you have Fidelity, you're going to be using FZROX. Pretty much any company that you're using, if you just Google comparable to VTSAX, you're going to find a fund that is the same thing to invest in. And usually you want to, let's say you have Schwab, you can invest in Vanguard funds, but typically it's going to be a little bit more expensive because they want you to invest in their version of that fund, which makes perfect sense. You know, it's their business model. So, yeah, with that, I just wanted to point out that for your 2020 401k limits, those have been increased from 19,500 to 20,500. So you have a little bit more tax advantage space to use an index fund like this. I definitely would suggest that you use your Roth or traditional 401k. And then also your IRA limits remain the same. You are able to invest $6,000. So definitely check that out because over in the long run, you're going to save a lot of money on taxes by using these vehicles. But Yeah, that's the stock I'm going to be investing in all year. Let me know what you think down in the comments.